Last year, the big, beautiful bill came into play. That means for me, you're too young yet, but me at over 65, I have an extra $6,000 standard deduction. Tax day is going to be very interesting. Now, we were under Trump's tax law already from the 2017 Tax Cuts and Jobs Act. It was sunsetting at the end of last year, which is why they had to do something. So we know taxes are going to be relatively low for the next, through his term anyway, 28, 29.
It's permanent.
Yeah, they said permanent
until the next administration, right?
Permanent until somebody decides to change it. But There's a lot of things in there, and I think we're talking about the markets as we do from time to time on the show. We don't control the markets. Nobody controls the markets, but you better have a strategy for when the markets are going the wrong direction, because we all like it when the markets are going up. But that leads us to that challenge, I think, which is we're going to talk about the next couple segments, are Roth conversions. Roth conversions. You say, well, you're going to be, because you have taxable, you have tax deferred, and you have tax free. Well, Roth conversions are in the tax free category, except to get there, you got to pay the taxes on the money you're moving. So give us an overlay, maybe an overview of what a Roth conversion, how you look at it, how do you help people figure out, does it make sense? Does it not make sense?
Sure. Well, we've all adhered to the conventional wisdom of, hey, put money in your 401 or your 403B or your IRA, put pre-tax dollars away, save on taxes now, because in the future in retirement, you'll be in a lower tax bracket. And what people find is oftentimes they are not in a lower tax bracket. And also those distributions, even if you don't need them, you have to start taking them out as required minimum distributions. And sometimes that's pushing people up into higher tax brackets. So there's a lot of moving parts, and it's important to look at your whole situation as a whole, understand what all the ramifications are of the taxation in retirement and how your pre-tax accounts are going to impact that. So one way to help mitigate that is doing Roth conversions prior to that time, paying the piper, paying some of the tax bill. Because here's the thing, your balance that you have in your 401k or IRA isn't what it's worth, right? If you got a $500,000 401k, it's not worth $500,000. In fact, we don't even know what it's worth. You have a silent partner in that account. It's your Uncle Sam. And here's the worst part about that. You don't know what portion Uncle Sam owns of that account.
They moved the goalpost? They moved the goalpost on us? Is that what you're saying?
Think about this. We all do it. We've all put money in pre-tax accounts. What business arrangement would you ever agree to that says, yep, we're going to go in on this, and I'm not going to tell you what portion of the business I own until we're ready to liquidate it at the end? Who's signing that agreement? Nobody. Yet every single American has signed that agreement. You don't know what you're going to pay down the road in taxes. So by doing a Roth conversion, you do a couple things. You can mitigate some of the tax issues you're going to run into in terms of Social Security taxation or Medicare surcharges, IRMA charges, and all that. But you also gain control. Because guess what? Like you said, we just talked about the Trump tax cuts. They're only as good until Trump's in office, right? And after that, who knows? They go up and down. They change all the time. We've all seen that. So we don't have control of that. If we can get money into a Roth IRA, that takes that entire tax talk out of the question and out of the equation. So there's a lot of benefit to converting to a Roth. Now, having said that, everyone's situation is different, and it's important to look at your specifics, your details. There's not a black and white answer. Just because your neighbor did such and such and you're taking advice from him, that doesn't mean it's going to be the right decision for you. So it's a tricky decision, and that's why it's not a great thing to do it yourself and have some professionals help you along the way to make sure you get it right.
And don't you feel like, though, the Roth conversions have become so much more important really with the going away of pensions? My grandparents retired in the 70s, so they had pensions, they had Social Security, right? They're going to retire to lower taxes. There was no question about it. Because of the 401k world, it started in 1978 when 401ks came to be. I think IRA is 1974, and then 97 and 98 is when the Roth portion of those two came into play, 401k and IRA, is that because the pensions aren't there and now those IRAs and 401ks keep growing, that's why we don't know exactly how much we're going to be paying. You pay almost, just under 4%, I think, your first RMD, but that number keeps going up and up the older you get. So the IRA, the IRS was pretty smart. The government was pretty smart in a way, saying, Mitch, we know you're going to start out, and now they didn't know you're going to be an NFL player for 7 years, so your salary was different than most just coming out of college. But one thing they did say was, Mitch, we appreciate your hard work. Go ahead and put that money in that 401k because we want you to have a great life. And then towards the end, we'll start taxing you back. Well, they didn't want the harvest. They didn't want the seed money. They wanted the harvest money is kind of what they, so really in a way it was pretty smart, but you could be jumping tax brackets going higher, not lower in retirement.
Well, we see it a lot, and there's a number of reasons for that. Number one, again, perhaps you have higher income than you thought, because of investment income, because you have got these large balances, and it's bumping you up into higher tax brackets. But the other thing is in retirement, you don't have some of the deductions that you were having before, right? Your 401k contributions, you're not doing that anymore in retirement most of the time. Your house is probably paid off by that point. You're not deducting mortgage interest anymore. So there's some things that, maybe people aren't thinking of leading into retirement that impact your tax situation. And to your point, most people don't have that pension anymore. So in combination with a Roth conversion and gaining the control and taking some of the tax equations out down the road, you can combine that with some different strategies to create kind of your own pension. And better yet, if it's done with Roth dollars, now you're creating lifetime income that's going to be tax-free, and you never have to worry about losing giving Uncle Sam more than his fair share.
Blueprints came under fire during the Biden administration a little bit because Peter Thiel from PayPal started his PayPal with a group of guys, Musk I think included in that, PayPal, and he put like $2,000 in the business 401k and put it in the Roth side, and now it's like $1 billion or some crazy thing like that. And one of the things that the Roth is really interesting about, and Mitch is going to talk about this coming up, but Roth conversions make a lot of sense for a lot of people. They do not make sense for everyone. So don't just blindly go take your 401k or IRA monies and go, I'm going to pay taxes on it now, move it to the Roth world. That's not how it works. That's right, isn't it? I mean, Roths are great for most, but not for everyone.
Yeah, and you're exactly right. And this software, our Roth Blueprint software, will analyze your specific situation. We're going to factor in your Social Security. We're going to factor in your pre-tax balances. How long do you have prior to your RMDs? Again, a lot of moving parts there that's different for everybody, and every situation is different. Taxation, your Social Security, how much is going to get taxed, your tax bracket, how much can we take out before bumping you up into a higher tax rate? So all that comes into consideration. It takes 10 minutes to get the information we need to run that, and then we can jump on a Zoom and walk you right through and show you exactly what that would look like for you, how much it will cost you in taxes, and suggest where you can pay it from. That's a big part of that equation is where are you paying the taxes from? Are you going to pay it from the IRA you're converting? So if you convert $100,000 and you pay $25,000 in taxes, are you going to only have $75,000 going into the Roth? Or are you going to be able to pay that tax from an outside source like a brokerage account or savings so that you get the full $100,000 into the Roth? Much better, much more effective, not always available to people. Maybe they don't have the cash to do that. We'll run that analysis and say, hey, does it still make sense if you pay it out of your pre-tax retirement account? We'll do all that. We do it on our dime. We're happy to do it because I think it shows, it brings clarity to people. And if they choose to implement some of those solutions, and they choose to work with us, great. But we'll provide that blueprint at no cost for them and show them how much they can increase their lifetime wealth, what they get out of their IRA, plus what they leave to their kids, how much more you can increase your lifetime wealth.
So timing opportunities are always interesting. If the markets are going down, it might be a great time to move some Roth money. How do you, there's certain things that can trigger, boy, it's a great time to do a Roth conversion, I suppose.
Well, that's a great point. And, for those of you that are looking on our video, the Slinky, everybody had a Slinky. You probably can hear it. I've got a Slinky on my desk, and I use this Slinky a lot to talk about, to show a visual, because Slinkies they can go up, they can stretch out. That's the market going up. And when the markets go down, it gets a little tighter, right? It collapses on itself. When the market collapses, people don't like it, right? Their net worth goes down. But to your point, that might be a really good time to do some Roth conversions because, hey, not only did your account balance go down, but your tax hit went down as well. Let's convert when those markets have contracted a little bit and then pay the tax on a lesser account value. Then when the market bounces back, as inevitably we see it do over time, now all that bounce back is all tax free. So while people don't like to see the market go down, well, that's an opportunity, and that's something that our team will help you with when the opportunity presents itself. Maybe that's a time to take a little more out of the Roth, and get more of it out because you have less of a tax hit at that point. So the timing, Warren Buffett says time in the market, but sometimes timing the market in terms of Roth conversions can make a lot of sense.
And I would think, let's say somebody had $1 million, right? Boy, they've done a nice job saving. They're not really sure where they are, but boy, the RMDs are going to hit in, going to cause us some issues down the line. And for RMDs right now, required minimum distributions, that is the age of 73 for me, age 59 or 66 right now, but born in 1959 or earlier, because it went 70 and a half to 72 because of the Secure Acts, then went to 73. So that's born in 1959 or earlier. And then everybody born 1960 or after is now 75. So they gave you a little bit more time, but also more time for that harvest to grow a little bit bigger, I guess. But if somebody had $1 million, you wouldn't say, you know what, Mark, this is a great time for you to take that $1 million. Let's roll it all into a Roth. It's not a one-time thing. It could be stretched over 3, 5, 8 years, I suppose.
Yeah, absolutely. I mean, obviously, if you did $1 million in year one, you're throwing yourself all those dollars into your, more than likely, the vast majority of those dollars into the highest tax bracket. So it might not make sense to do it all at once. But if you've got, 5, 6, 7, 8 years until your RMDs even start, we've got some time there to play with it. And that's what the software will model. We'll show you exactly your baseline. Hey, here's how it currently stands with what you have. If you don't do anything, what will that look like over your lifetime? What will it look like during retirement with the taxes you pay? And what will you leave your kids ultimately? All right. So we can show you that. And then, hey, what if we did turn the Roth blueprint on and boom, and it'll show you optimally the difference. And sometimes it's staggering in terms of the wealth creation just by making some of these moves now versus waiting. And to your point on the RMD getting extended, it looks good on paper. Oh, great. We don't have to pay taxes for another year. Well, all that did is make the problem worse. Now the balances are getting bigger. So hopefully that's not necessarily a good thing. So we look at all that. Things that come into play, people kind of forget the widow's tax, the widow's penalty, when a spouse passes, all of a sudden they've lost that deduction for their spouse. They might have less income because they lost a Social Security payment. But what they find is because now they're in a single filing tax status, they're actually paying more tax on less income. We can model all that for you and help you avoid that entirely.